Hello, everyone, and welcome to our live stream. I hope everybody can hear us. I'll just wait for a couple of more minutes for more people to join in to the stream. Very interesting time in the markets right now. Very interesting time. On the macroeconomic front right now, we're seeing so much happen. Uh, and we'll sort of go through all of it in today's stream. We'll just try to understand uh, what are the macros telling us, what is there in the market where we sort of want to allocate, right? We look at the factorial view, right? Which factors sort of are looking interesting. We'll also look at sectoral view, right? Which sectors are looking interesting. So, if you guys are interested in trying to find out, where to allocate in the market, please stay tuned. I'm seeing not a very strong viewership today, probably because we've not been doing this very frequently. But yeah, I'll just maybe wait for a couple of more minutes, more people to join in, and then we'll start. A very interesting time in the market, very interesting time in India. It's really hot out here in Bombay, and yeah, I think there's a lot that's happening in the world. I think everybody is tuned in to understand if the Iran war, if the Iran deal would sort of happen, right? How does that go? I think Donald Trump has almost said it 40 times that the ceasefire is going to start, but nothing has happened as of yet. So we'll see how it goes. But to begin with, I'll just quickly maybe take you guys through, what our agenda for today is. All right. Okay. So this is the presentation that I sort of wanted to do today. The idea is that look at what's happening in the macro from a data driven perspective. What we do at Right Research is purely quantitative. People who are not aware about Right Research, we are a quant driven investment research provider as well as a portfolio management service, and we've been doing this for a very long time. We've been in the market navigating all the volatility in the Indian market for our investors in 2019. And yeah, I think we'll be going through what this tells us about the market. In the meantime, maybe I'll quickly give you an overview of our PMS products as well, right? So we offer this quant driven PMS called the Right Factor Fund, right? So the idea is that we try to break down the market in terms of factors like momentum, value, quality, growth, etc. And we take a totally data driven approach on how we allocate. The idea is that if you are we think that using quantitative methods you can have a lot of advantages over the traditional method. You tend to not be deviated by the emotions, not be deviated by the biases. Your analysis is fast, much more automated, and you have a much more consistent way in which you sort of allocate. And now with the help of AI, now with the help of all of these things, you're seeing so much progress being made. I'll quickly go through the performance of our funds the recent times. So we have two funds, Factor and Alpha. Our Factor strategy definitely is doing extremely well. If you look at this on all 1 month, 3 month, 1 year, and since inception basis, right? I think the strategy is now finally shining. I think 2025 was a slightly volatile time for our strategies, and then maybe I'll just quickly take you guys through that as well. So here I have an analysis of our factor strategy, and you see that okay, we've seen volatility in 2025. I think the first part of 2025 was volatile for us, but let's look at 2026, right? 2026, I think the strategy is definitely coming into its own, you can see a good 10% outperformance of the strategy over the market. We have some strong multi-baggers that the strategy has picked up. I think the sectoral allocation, how the strategy allocate to sectors is quite beautiful, right? If you are a fundamental investor, who's looking at trends, you'll see that our strategy is always in the right sort of trends. Like right now, we have a few data center stocks. We had the autos uh, allocated to a lot in the previous quarter. Right now, we do have auto ancillaries, which are now also playing a part in the data center space. Then, you're seeing some very interesting tactical bets coming up with the financial, even in the consumer section, which is very interesting, right? So this is what we have, and I think the trends are becoming strong in favor of our strategy. I think the execution has been very beautiful, and I think this definitely is an interesting strategy for you guys to look at if you are looking to invest into a portfolio management service, if you're looking to invest into a strategy that can differentiate, that can be good for you in a volatile market. As our strategy is sort of proving out to be, if you look at the previous some 10 months, I think out of 10 months, 7 or 8 months, the strategy has outperformed the market, right? So I think you know that's coming out together really well, and that speaks to the power of the quantitative method, right? Obviously there was a period of volatility where a hedging strategy that we did wasn't that strong, but since then the strategy has picked up so beautifully, and it's steadily building up the outperformance, which gives you a lot of conviction on what we have to offer. So having said that, let's come back to the presentation that I prepared for you guys. I can see a few people have joined in. I hope more would join soon, but let's begin this, right? So yeah. So idea is that we want to understand what's happening in the macro sphere, and we want to understand which factors and sectors to allocate to, and we'll do it purely quantitatively. Like we'll look at data and we'll give you a very clear picture on how to allocate, right? So first thing we'll look at is the regime composition, right? What is the macroeconomic regime telling us? Now, regime, it's a difficult word, right? What does regime mean? So basically, the market goes through phases, right? It is a strong bull market or is it a bearish market, right? So what is the market phase we are in? And it's not just like binary bull or bear. It can be a period of accumulation. It can be a period of bullishness. It can be a period of high amount of fear. So I think March of this year was a period of high fear, right? Whereas right now, I think things are interesting. You can see sentiment definitely has picked up, right? It's not as bad as before. So maybe I'll quickly show you guys our sentiment indicator, which I call the fear and greed indicator here. So you see that okay, the sentiment went really bad, right? It sort of went quite bad in April, and very interestingly, now you can actually, if you're looking to track the fear and greed index offered by Wright Research, you can track it on our website as well. So, here, if you come to the fear and greed tab on the tools section, you see the fear and greed index. Like I was saying, it went through a period of very deep fear in the last 6 months, but now, it has recovered. But, there's been a pressure it's not like that the sentiment is just going up and up. There's been pressure on the sentiment recently after the, deal negotiations have become stronger. You can see there's a pickup in sentiment, but yeah, I think sentiment is at a moderate level, or right, because understandably, because the Iran war situation is sort of having an impact. On the other hand, looking at the stress index, right? So there is stress in the market, right? There is we'll look at it in the further slides. You'll see your inflation fears are increasing, and your growth is being reduced, right? So that has been an impact. On the other hand, if you look at the liquidity in the market, institutional flow has been strong, right? You see DIIs are still pumping money even though FIIs are slightly reducing. We also have a very interesting macro page that you guys can track here on our website. So you'll see here on the macro page that we have that okay, the FIIs have been slightly They've been selling consistently, but DII flows have been strong. Obviously, there's been some slowdown in the DII flows as well, but that has been also, that is something for you guys to look at. So what the economy is telling us, that we are structurally neutral. There is stress in the market, there is stress in the economy as such, and it's all driven by the external macroeconomic shocks that are coming in. The fear and greed score that I showed you, we are in a moderate space. There is you know there is a lack of conviction in the trend in the market, right? Volatility is high. People are rushing to safe havens, right? And that is what is happening in the market. So right now, the market situation is that people are not buying the dip, but what they're waiting for is a fundamental catalyst, right? So that's something that we covered in our last video. If you guys checked that one out, right, we covered something called the mega trends in the market, right? So obviously, we identified the three key mega trends, but along with that, what's very important is that people are focusing a lot on earning visibility, strong execution, more than anything else, right? So it's not just about the price momentum, but the earning momentum, the earning growth has to be strong, and that's what people are betting on. Now, see what has happened in the market. We all know, right? The geopolitical trigger where America attacked Iran. America and Israel sort of attacked Iran, and then Iran closed the Strait of Hormuz as a retaliation measure, and that sort of sent out commodity shocks across the world, which led to this whole Strait of Hormuz. It controls 20% of global supply, which means that it has totally disrupted the global commodity supply chain, and that led to a commodity shock. Crude prices jumped up 20%, and I mean 70%. It went up to $120 in March, and then right now it has cooled, right? I mean, it was sort of static around 103, and now it is at 88 today, right? So if I look at Brent crude today, you see this is the when the attack happened on 28th of February, right? And quickly crude sort of spiked up to the highest point of $120, and then it has been sort of hovering around the 100 levels for a while, and then right now it has cooled down quite a bit to 88 level, because there is I think Donald Trump has again claimed for the 39th time, I think, that the ceasefire is going to happen. But let's see how that goes, right? uh, but the economic narrative is totally tied up to the West in Asia situation, right? And the crude prices are going to totally dictate what's going to happen in the emerging markets. Now let's talk about how India is coping up with this shock, right? I think first thing that's happening is that a lot of foreign outflow, right? That's something that's really weakening the rupee, really putting stress on the RBI to manage the capital supply, the FX reserves, right? You'll see the FII selling is definitely having an impact, and RBI is right now doing a lot of interventions to keep the reserves robust. But there is structural stress, in India's capital supply. But yeah, I think right now, let's talk about today. I think now the war has been going on for more than 100 days, but even recently, uh, I think if you track the situation as much as me, if you monitor the situation as much as me, you saw that early last week, right? There was a huge escalation where Donald Trump again said that we are going to destroy Iran, and then he said that okay, we're going to do a ceasefire. We will sign something in the next couple of days. But it's the 39th time that he's said that. So take it with a grain of salt. See, I think right now there is again a 60-day negotiation window where they're going to decide what happens. There are two scenarios that could happen. Number one, a deal is signed. If a deal is signed, then oil prices will cool off, and we just have to position ourselves for the rally. Right? We'll have to position ourselves for the relief rally, and we'll see strong recovery happen in the market, right? On the other hand, if there is again a delay and hard negotiation where they're not able to find a way forward, that could lead to again crude inching up to $100 a barrel, and that would lead to high inflation. We're already seeing inflation inching up. We'll go over that also, but that could also have an impact, right? And then eventually that will also have an impact on earnings, right? Earnings of corporate India. And then you would, what you as an investor would have to do is go more defensive in the market. So it's all tied up to the US, Israel, and Iran war. Again, let's see, another important thing that we have to look at is the El Nino effect, right? So I think if you follow the market, you're looking at the commentary. There's a lot of talk that's about the El Nino effect, which is effect where the ocean warms up more than usual. I'm not very scientifically aware of that, but that causes the monsoon to be impacted, right? So Indian monsoon could get impacted, and right now the prediction is that the monsoon would be highly impacted, right? And you see that a different this chart sort of shows you that we are in deep El Nino territory in certain areas, and that could have like a huge impact on the supply chain, because rural agricultural base would get impacted. That would lead to lower farm yields, right? And then eventually, you'll see subsidies would need to be given by the government. If subsidies are given by the government in such a situation where the capital account is already under pressure due to high commodity prices and due to FII selling, that could again put more pressure on the capital account and the current account deficit. So I think this is also something that we'll have to watch for, and we'll actually hear a lot about it in the coming few months and quarters, right? Now let's talk about what the central bank is telling us. RBI has increased the projection for inflation. The past projection was 4.8%. Now they're projecting 5.1%. In terms of GDP, it was previously 6.9%. They've come down to 6.6%, right? So the RBI is explicitly acknowledging this. Previously, the narrative was that they want to boost the demand growth, right? So there was rate cuts that happened. I think few rate cuts happened this last year, and the idea was to boost the demand-led growth. But right now, the RBI is focusing on supply-led inflation, right? That could have a impact, and that's what they are sort of bracing for. And yeah, I think if the situation with the Iran war is not, we don't see a solution in the next quarter or so, then there could actually be a fear of a interest rate hike, not just in India but even in the global markets. Now let's talk about some other high frequency data that comes from the market. So here, first thing is the FII flow. You're seeing massive outflow, and I think that's dragging metals and IT quite a bit right now. But FII flows, the data has been interesting. If you look at March, if you look at April, there was exceedingly high selling. But if you look at May, the first half of May, there was a lot of selling. But in the second half of May, in fact, FIIs have bought into capital goods stock, they bought into telecom, they are selectively also buying, right? Which is very interesting. In terms of domestics, I think the SIP flows remain strong. There has been a cool down in the equity flows, at least if you're looking at month on month, quarter on quarter. But yeah, I think overall, year on year, we're seeing a rise in SIP flow, and I think that is what is really supporting the market. Uh, in terms of industrial production, you're seeing positive signs, right? I think that has been something that is really driving the market, and that's why you're seeing industrial. That's why you're seeing capital goods actually do well in the market. So we are in a tug of war situation where foreign capital flight is being absorbed by the relentless domestic liquidity, and not just the liquidity coming from SIP flows, but also the resilient industrial activity. So I think that is also something that we have to acknowledge, that the industrials, that segment of stocks are actually doing quite strong right now. Now let's talk about the fiscal balancing scale, right? What that means is uh, fiscal discipline versus consumer buffers. Right? What that means is that okay, the the RBI and the policymakers are at a very delicate situation right now, where they also want to do fiscal discipline, which means they don't want the deficit, right? Which means they don't want to the deficit to be very high, right? Because if the deficit becomes very high, that has a negative impact on the economy, right? That will make us very precarious in this situation where risk can rise high. But on the other hand, the government also wants to sort of buffer the consumer, which means that if the monsoon is not good, they want to subsidize some of the farmer fertilizer and farm equipments, right? On the other hand, they also would sometimes absorb, like right now though, the petrol and diesel prices have been hiked, but the government could also absorb some of the crude oil volatility, right? So there is a very delicate fiscal balance that the policymaker sort of needs to maintain. And policy is acting as a shock absorber, because if there was no uh, policy to balance it, it would have a bigger sort of a impact on certain sectors and stocks. But what it is telling us is that you know if you look at the key metrics right now, right, one is your crude oil spike, the global macro, 20% of the world's energy supply is impacted. Crude oil prices are at a much higher level than before, right? From 60 to 120, they have gone up, and right now they are hovering around 88. So macros and crude oil is going to have an impact on the market. Second, El Nino effect, which means that the monsoons are impacted. That is going to have a that's also put some risk on the situation. And then your rate cuts, right? Obviously the government is not going to cut rates when they see such a situation where the currency is depreciating so much, and there's a high impact on India's current account also. So what that means is, it doesn't mean that you are not going to see investing opportunities in the market, right? First thing, right, there are risks, but that doesn't mean that you can't invest in the market or you can't make money in this market, right? What that means is that your market beta. What that means is that if you're going to do passively investing in the whole market, right, then that might not be the best strategy. So if you are looking to invest into beta, or if you're looking to invest into passive funds, I think that would get impacted. And in fact, I think that's what you've seen also, right? If you're looking at the chart of Nifty and I compare it with, let's say, a small cap, right? So in the recent times, you will see that okay, uh, your small and mid caps are doing much better than the larger market, because earnings were very strong for the broader market, right? That is what is having like a positive impact here. So uh, so what that tells us is ki, investing just in the passive beta will not be the best strategy. What you have to do is that identify companies where you have earning visibility, right, and which are stable in these commodity shocks, right? So that is what will help you make money. And I think obviously there are various stocks through which you are making money in the current market. So if we want to understand which factors to invest into, right, the topic of the presentation or the webinar or the stream that we're doing is, where do you invest in the current market? Diagnosis is that right now there is some sentimental fear, but liquidity is strong, right? And valuations are decent, not very attractive, but in a decent place. Market reaction is that it is very diverging, right? There are certain factors very impacted, and the certain factors that are doing well. So what is working really well? Valuations, um, earning momentum, and long term momentum, right? These are the strategies that are working well, right? So value, earning momentum, and momentum, these are the factors, right, if you actually look at it, which are doing strongly. On the other hand, very high beta stocks, stocks where the stress metrics are high, or even stocks which are high quality in nature, right? Those have also been impacted, right? So the quality factor is also not doing that well in the current market scenario. But what we think is that right now, at least in the current market scenario, what our model is clearly telling us is that we are moving towards long build up, right? Slowly and steadily, the market is sort of, if you're looking at the broader trend, broader momentum, right? The market is sort of tilted towards long build up, right? So while the fear and all of this has been there, right now our model is clearly telling us that there is a slight tilt that's happening, and which is will be in favor of companies that have strong earnings momentum, right? Earning momentum means that they're executing very consistently, and they have strong growth projections, and long term momentum, which means price is supporting them, there is buying in those stocks, plus the valuations are not extremely high, right? So if you look at uh, comparison here, right, you'll see that that earning momentum, etc., have been the best performing. Value has been the best performing strategy. On the other hand, efficiency, which means quality and growth, historical growth, they have not done that well, right? So very clearly there is, and we've, I think, talked a lot about it. If you follow our research, if you follow our videos and our newsletters, you'll see we've written a lot about how momentum is picking up over quality, how momentum is actually seeing a recovery. And yeah, I think the situation is somewhere or the other turning in favor of that. um, in terms of what is really being positive negatively looked at, so illiquidity. So if you have a very illiquid stock, that is having a very negative impact. Stocks with high stress, right, which means debt to equity ratios are being very high, or extremely overvalued, or any other financial stress that the company has, that's leading to correction. Plus, if a stock has high exposure to the US dollar, that's also seeing negative returns. So that is something that we are seeing. On the other hand, stocks where you're seeing high projections. Secondly, very drastically, stocks where you are seeing a lot of sales happen in the EMEA region, right? So instead of US, if you're looking at the EMEA region, that is where you're seeing a lot more growth, right? EMEA, what does EMEA mean? It means Europe, Middle East, and Africa. So instead of the US, if the country is selling more in the Europe, Middle East, and Asia and Africa region, those companies are doing well. And then also somehow companies with exposure to volatility and inflation are also doing well. So if you were to look at this chart and where do you want to allocate, I think it's very clear. The alpha generators right now are stocks that are that have momentum, that have industry relative growth, and then they have strong forward projections. Right. On the other hand, what's destroying alpha is high volatility, high stress, and high beta. Right. So if you're looking at this matrix on where do we allocate, right? And what the macros are telling us, right? So in terms of VIX being slightly high, that tends to support valuation and targets as a metric, right? And it really destroys, or really does not support illiquid stocks. On the other hand, if you're looking at uh, weak macro score, that is really sort of, so this is what we're seeing in the current market. um, uh, you know the weak macro score really sort of impacts the beta and the volatility based stocks, so, or low volatility stocks. So you have to stay away from the beta factor as well as the low volatility stock, and the strong institutional capital flow, especially by the DIIs, and even I think there's been buying by FIIs also in the last month, in fact. And we'll see more numbers come in soon, about June also. I think momentum and targets and valuation, I think those are the factors that you have to focus on. So that's the playbook that we have, that focus on earning momentum, long term momentum, and companies that are doing good related to the whole industry. You have to be neutral to growth and short-term momentum, and you have to be underweight maybe quality, illiquidity, beta, and low volatility. Right now, let's look at again on the sectoral front and on the broad market front. So if you look at so this is a heat map of fund performance on the mutual fund space. You'll see that the capital is flowing into small and mid cap funds right now, right? And you're seeing despite the macroeconomic uncertainty, momentum, size, etc., are doing well, right? So that is what even the fund flow is telling you. Let's look at earning versus valuation, right? So there is a balance that you have to maintain. Nifty is closing to its historical mean at 19.5 PE, right? EPS estimates are, you know, I think this time the earning was pretty decent, right? This earning season, but looking at the macro situation, there could be downgrades. I think obviously the growth projections that we had of the upcoming quarters that has been cut down because of the global situation. And but yeah, I think there are companies like we've done. I think last few videos have been like the mega trend video was on the data center theme, the defense theme, as well as the EMS theme, where you're seeing very strong earning momentum along with price momentum. Then we've also done a whole video on AI investing in India, right? Which again, ties up into your data center and all the ancillaries. Even auto ancillaries play a role there, and there are so many interesting stories and companies in that space, right? So there is obviously growth pockets, and that is where we think that you'll make alpha. Now let's try to look at on the sectoral front, right? What is looking good and what is looking bad, right? So obviously IT services are on the sidelines, right? There is no commodity risk, right? But there is also low near-term demand visibility. I think AI is having an impact there, and IT services have been on the sidelines. In terms of safe harbor, I think pharma, healthcare, defense, and renewables, right? I think those are getting strong numbers. I think pharma, we also selectively added a few pharma stocks in our portfolios. Defense has been a very strong theme, and renewables also. um, and I think a lot of companies in this space also tie up into the data center theme. So that has also been a strong safe harbor. Where you see vulnerability is maybe autos, right? FMCG and some banks, right? This is driven by the macro vulnerability. And where do you see tactical opportunity? I think oil and gas and power, right? I think cooling off of crude prices could benefit certain oil and gas stocks. Plus power, we're seeing power play a critical role, and there's been a whole thesis of investing in the power transmission and the evolution of India's power sector with the advent of AI and data centers. So that could be a very interesting play. But again, we are susceptible to commodity prices over there, right? So, uh, so the idea would be that maybe looking at pharma, healthcare, defense, renewables, even power, oil, and gas could be an interesting point. But commodity price definitely have to be carefully looked at in the current scenario. So yeah, that's what where are we overweight? Again, this is not an investment advice. I forget to give disclaimers on these live streams, but uh, this is just for you know research purposes, education purposes. This is not a recommendation for you to buy or sell anything. What we think, our analysis, our numbers tell us is pharma, healthcare, infra and defense, and metal and power are our beneficiaries in the current macro scenario. And banks, automobiles, and IT services are underweight. Why is pharma looking interesting? Because the supply chain diversification, INR weakness, right, are helping, and Indian players are now transitioning to innovation partners. On the infra and defense side, you're seeing there is asset creation happening. The order books are deep and they're insulated by the consumer slowdowns. Metal and powers are sort of beneficiaries. The energy transition is really helping the power sector. uh, on the other hand, banks, definitely there's been a few announcements by RBI which have been positive for the banks, but there is a earning growth constraint, and even though credit is growing, there is a constraint on earning growth. Automobiles, they're facing margin pressures, and again, the El Nino effect will have an impact on the rural facing auto sector, the consumer vehicles, the two wheelers, etc. Right. So that is something that we have to look at. IT services, I think Gen AI based productivity pressures and stagnant global discretionary spending, those have had a negative impact on IT services. So we are in a deep global cross current, and the survival and outperformance here requires abandoning generic beta. What that means is you have to be selective of sectors, selective of companies. You have to look very carefully at the macro scenario. You have to look very carefully at what's happening in terms of earning growth, in terms of earning stability for the companies and also for the sector before you allocate. And I think that's where you know uh, it's a stock pickers market in a way, like we say. And I think generic beta might not be very interesting in the current scenario. So that is all I had in terms of a presentation. Let me look at questions. Oh, wow, we have a lot of questions coming in. I'll bring in Siddharth to the call, and we'll just go over the Q&A section.
Yes, sure. Good morning and thank you for the presentation, Sonam. So I'll start with addressing the questions on the chat first. You were talking about the El Nino effect and also, the rising of crude oil prices. So a lot of investors and viewers are asking, do we have something like a hedge strategy? How do they hedge their portfolios when it comes to such situations? If you could talk a little bit about that.
Yeah, I think we do have hedge strategies that we deploy in our PMS at least, and even on the retail side, we are exploring how do we deploy them. So right now we are going through exchange approvals for some of our algo products, right, which can be a very interesting way for people to hedge their equity holdings. We have two types of ways of hedging. One is where where we just do like a tail risk hedging. You buy puts when you see high risk, right? Those type of strategies. And second is where you can sell calls to take advantage of the theta decay. We both these strategies, very interesting strategies that we sort of look at right now. Neither of those are being triggered, right? Specifically because the VIX levels have cooled down, right? So there is no need to buy puts. uh, so yeah, I think we do have that, and we'll hopefully offer that across as algos also soon.
Right. The next question is on gold and silver, again around volatility in the market. Do we have gold, silver sort of positions in any of our strategies? Do we intend to take them? And what's your opinion about this as an asset class in the current market context?
See, we've had allocation to gold and silver, right? uh, but like right now we don't. So let's quickly look at your gold prices. You see, there's been a lot of cool off, right? But I sort of believe that this could be again short term in nature. I think 2026 hasn't been good for gold, right? We were holding gold. I think we sold a lot even here, and then also we've just reduced and sold off all our gold right now. But yeah, I think, see, the macro scenario, if we try to understand on the macro side, see what's happening is, while the Gulf of Hormuz and the situation is still, being negotiated, and it's out there on the our day to day news cycle. But if you look at the broader trend in the market, right? With the US having attacked Venezuela, if the US now looking at Cuba, and their ability to sort of causing geopolitical risk, and even with Iran, right, they can really come and impact 20% of the supply chain, right? 20% of global supply chain when they are attacked, right? So different countries in this scenario, right? are looking at alternatives, right? How can I diversify away my energy needs? How can I sort of go away maybe from the petrodollar system? How can I get better energy security and better, capital security in my country, right? So which might lead to, people, uh, prioritizing investing in gold and silver, which are stores of value. But if you look at gold prices, there's been a very sharp spike, right? You've seen very sharp growth, right? And now you're seeing cool off. I think for the cool off, there could be multiple reasons, right? One is, uh, I think the overvaluation over here. Second is this: people are taking out liquidity from the gold, uh, and maybe using that to invest into these large IPOs that are coming in the market, like SpaceX IPO at $2 trillion yesterday, right? So people are putting in money, taking money out of gold to invest into there. If on the stock side margin calls are hit, they have to sell gold to sort of uh, you know make up for the M2M in the stock space. So right now, see, I think we could see some consolidation in gold, but yeah, I think the long term trend and the long term story for the need of precious metals is still intact, I think.
Right. Talking a little bit about the SpaceX IPO, a lot of viewers are very curious about it to know your opinion on it. Number one, and number two, in the same context, how do an investor look at global investing right now, given
Mm.
that Indian equities are not giving the favorable returns, but markets across the western part of the world are giving those kind of returns that investors are seeking?
So very good question. I'll maybe take you guys to our Instagram page now, right? So we recently made, and everybody on the stream, please follow us on Instagram as well, so that you receive updates from us. So you see here that SpaceX right now has sort of IPO'd at $2 trillion, right? Right now it's at $2 trillion at 165 dollar per share, right? And if you look at compare SpaceX to all the companies in the $1 trillion plus market cap, right? You see SpaceX has a revenue of 20 billion and their net income is minus 5 billion, right? On the other hand, if you look at most of the other companies, like Apple has a revenue of 4.3 trillion, Nvidia has 5 trillion, Amazon has also 2.7 trillion, right? So basically, yeah, so basically, obviously SpaceX is slightly, it is fundamentally, it is at a very interesting situation, right? Where it is a very good company. I think SpaceX itself, right, with their ability to make these rockets which are able to land back, right? And then right now I think they sort of serve a very high percentage of all space traffic going out. That's an excellent product. Similarly, Starlink is an excellent product. Right now it's providing internet, very high speed internet, to a lot of places across the globe, which was not reachable before, right? So that's also a very interesting product. On the AI side, they haven't done well. But what this API, but if you like sort of go deep into this IPO valuation, what you see is that what they're projecting is that, like literally, if you go and look at, and I was doing this analysis, right? If you look at their IPO projections, maybe I'll quickly sort of pull that up for you guys, right? Hmm. So, what they are sort of projecting is, uh, let me just take you. Okay, what they're projecting is that AI is going to go 100x by 2020, 2030. Right now, it's 2.2 billion in terms of revenue. It is going to 322 billion, right? So it's going to go 100x in 3 years, right? So there are some very, very lofty sort of projections that are out there in this particular IPO. And even in if you look at the other numbers, right? Your this one. even Starlink, right? And even your this one, um, the space division, the very high projection that are there. But I also tweeted about it, that they're doing a lot of price engineering. There is, if you sell your IPO within 3 months, then Fidelity is not going to let you, or these brokers are not going to let you invest in IPOs again. Also, there is things like I think Elon Musk holds 85% of the whole company, and then that is logged. So the public, only the free float is only 15%, and even of that, a lot of it is logged, right? That they can't sell in that sense. And then I think there is also, uh, they've negotiated with the S&P and Nasdaq that the index inclusion will be quick. So very soon, the 401k accounts in every American would have a ownership of this stock indirectly. So yeah, I think see, certain parts of the company are very interesting. It's extremely overvalued, and it will be very interesting to see how does it find its fair value, right? So I've spoken a lot about it, but yeah, it's very
Right.
interesting. I think if you
Right.
are looking to invest into global companies, I think AI, definitely you're seeing this huge capex. It's still interesting, I think, as a capex story, but I think the overvaluation, especially as if OpenAI or Anthropic reach that IPO at such high valuation, right? And if there is, if you see dumping of stocks at any escalated levels, that could be a trigger. So I would tell people to be a little bit careful of that space right now.
Right. Extrapolating on that question, could you talk a little bit about how someone can take exposure to AI stocks, semiconductor stocks, data center stocks in India, in the Indian context, and do we have any exposure there as well across our strategies?
We do have like a lot of exposure. So very interestingly, this one stock, MTR Technologies, right, which supplies to Bloom Energy data centers in the US. So we've seen like 200% returns in that particular. So stock had gone 3x in our portfolio. We're still holding that for stock. Then we have exposure in the transmission space, right? We have stocks in the energy transmission that we've been holding for a very long time. I think a lot of auto ancillaries and companies, again, ancillary companies who might be supplying different portions of the data centers. We do have, I think, solid exposure to that in our portfolios. And yeah, I think, see, if you maybe, if you're interested in that, I would highly recommend that go over the video that we made on the data center space, the mega trends recently in the last month. There's a lot of knowledge, a lot of research that has gone into that. But yeah, I think I would recommend that, I think, see, as the AI story is growing, that's leading to growth in data centers, and that's what, that's a very interesting opportunity right now. I think that's a very solid opportunity right now in India.
Right. Given the volatility in the market, do you
Mhm.
think it's the right time for investors to look at lump sum time correction investment or still continue the SIP way?
It's a very interesting question. I think, see, you could do SIP given the volatility that's pertaining in the market right now. Uh, but yeah, if the goal for Hormuz is open, please do a lump sum. Right? I think I would highly recommend. But what we're seeing, even with our investors right now, is a lot of investors are doing lump sum top ups. Right? That's been something that people are sort of following. So yeah,
Right.
so I think, yeah.
Right. You were talking about the VIX index also. So do we also use the VIX index to choose the investment timing in our strategies? Can you talk a little bit about that?
Uh, so VIX index, we look at it in various different ways. One is as a metric that defines the risk in the market, right? So when even in our fear and greed index that I was showing you, VIX is a metric that we look at. When the VIX gets escalated, that's an indicator that there is fear in the market, right? So that sort of influences our regime story, right? Typically, a high VIX means that the regime is volatile, right? That's what the data tells us. So that leads us to reduce risk in our strategies, go to slightly safer stocks, right? And when the regime index is when the VIX index is low, that leads to us taking more risk. That gives us more risk appetite. The VIX index also plays an important role in the hedging that we do. So, if you're looking at option strategies, looking at volatility, VIX, your implied volatility is very important. So, both the hedging strategy that we run, one is on the buying puts and calls, and second might be selling uh, options. Both of them are highly aware of the VIX that is there in the market.
Right. Is this a good time to take leverage and invest in the market? Do we have any strategies that make use of margin or leverage that investors can ideally sort of directly invest in as well?
See, I think we have a lot of interesting margin trading MTF strategies, right? But those are not out directly on the website. We do it in collaboration with brokers, right? So we've been doing it with a like I think we're working with one broker. We have a lot of clients who are doing MTF over there, and then we have around two to three more brokers who are evaluating it, and I think one is again going live soon, right? So we do that, and MTF is a very interesting where you want to, because you charge a interest when you take leverage, right? So you want to get faster returns. I think that one is also doing extremely well, right? I think in the month of May, our MTF strategy has done 10% outperformance over the market. So we do that, but right now we only do it with specific broker partners.
Right. As across our strategies, we follow a factor sort of a model. Currently, which factors is the strategy sort of picking actively? Where is the maximum allocation? Is it value, earnings quality, or momentum?
Yes, so I think I went through a lot about factors, right? What the data is telling us in terms of our strategies are allocating to momentum and earning momentum, right? Those are the two factors that we are sort of focusing on along with valuations, right?
Right. Perfect. We have a question on PMS. An investor wants to know that is there any lock-in or exit loads in the PMS that we have? Um, and also, how soon do we invest their money in equities itself once they give us the money for the PMS?
So we don't have any lock-in, right, in the PMS. And how do we invest? I think we are very aware of the market situation, right? Until unless the client tells us how they want to allocate, we would do it as per what the market is telling us. So I was showing you the fear and greed index. I'll maybe just share my screen and show you that one again. Uh, hmm. So you can see this fear and greed index on our website. So typically, the idea is that when market is in a deep fear territory, that's when you want to allocate, because that is when you make a lot of alpha also. You see strong upgrowth. So I think we deployed a lot here. I think we also send out communication to our clients. Ki, please top up if you want here. And since then, you've seen a good 15-20% recovery, right? So typically, what we try to do is we deploy more when there is fear in the market, and we tend to deploy slightly slowly when we see that there is some sort of a overvaluation. But yeah, I think that's what we typically tend to follow. So we might not deploy everything on day one until unless the market looks. So like we have deployed a lot of money on day one also, but that's when that was typically in 2023-24 when the market was going through this strong bull phase, right?
Right. Perfect. One last question that I can see. Just a minute. Yes. So, few viewers are also asking that do we track news in terms of investment for our strategies or company specific events?
We do. See, I think news flow definitely we do track, and typically, every news flow will not have a direct impact, right? Typically, any news flow that tends to impact the forward projections or something like that, that tends to be very powerful. And yeah, I think we do take care of that. I think even so that we maybe I'll quickly show people this one, right? uh, that
Sure.
if you look at some of our, like, we created a presentation of the multi baggers, etc., in our portfolio, right? So there have been various examples, if you look at, right, where we have made very strong performance. But what's also very interesting is that the exit has been very aware, right? So we don't sell at every news or every small correction in a particular stock. But typically, when the news actually has a direct impact, for example, Maharashtra scooter, this is stock we sold at the right time. Cartwright Tech, again, we sold it at the right time. Since then the stock corrected quite a bit. Indigo, you see, Blue Jet again, right? So I think when the news has a direct impact, right, I think so what we think is that our strategies are quite good at sort of identifying that exit also. And it is driven by whatever is happening with the company in terms of news flow also.
Right. Perfect. We've addressed all of the questions that were there, at least until now. For viewers and investors who have further questions, you can write to us and we will reach out to you. Closing notes from your side, Sonam.
Yes. So first of all, thank you everybody for joining us. We haven't been doing this that frequently, but yeah, we have to actually be more frequent with these live streams. I think it's always a lot of fun, right? It also helps me. I tend to prepare a lot for these live streams. Very interesting. It's also interesting to talk to you, see all your questions. We'll do one again soon. And the market is so interesting that we have to be out talking to you, more frequently. So thanks a lot for joining. I hope you found this presentation interesting. And like Siddharth said, do reach out to us, for any other further questions.
Yeah. Thank you for your time, Sonam, and thank you everybody for joining in on a Sunday morning. Thank you.
Thank you.